Welcome back to part 2 of the book review, where you know what we're about to do, and that is review Principles for Navigating Big Debt Crises, my favorite finance book of all time. This is going to be a 3-part series. This is video number 2.
We got our notes here, and I didn't know it was freestyling, so I'm going to keep going like the cadaver deer, making up words like a little deer, getting hit by a car, deer in the headlights, press the light, press the gas, and then we on this motherfucker's ass. Big Debt Crisis, the notes. But no.
Anyways, guys, we're going to go through these notes, we're going to read them, and we're going to elaborate on the things that are not self-explanatory. And the goal is to just understand the financial system as much as we can.
Is it, or is it to understand this book as much as we can? Or is the book the financial system?
Fuck. All right, here we go. While tops are triggered by different events, most often they occur when central banks start to tighten and interest rates rise. In some cases, the tightening is brought about by the bubble itself because growth and inflation are rising while capacity constraints are beginning to pinch.
I.e., where we are right now in terms of Federal Reserve monetary policy. We raised rates 500 basis points in response to an overheating economy or potentially overheating economy with really respect to inflation for the most part in this last bout. And this time, I hate saying this, but it's like this time seems to be a bit different in that in the economy post or pre-pandemic economy, yeah, you find tops during times of monetary tightening because they're usually tightening in response to a bubble. Now, the bubble that they would have been responding to is probably the AI bubble, but I wouldn't say that we've seen a top in the market yet. Crypto or stocks, we haven't seen the top yet. Or real estate, we just haven't seen it yet. We got some room to run. It could just be a lagging effect because, monetary policy does act with long and variable lags. But it doesn't seem to me that we are experiencing a blow off top in any sector right now at all. Even though we were tight over the past 2 years and now we're getting ready to go to an easing cycle. So in my mind, there's more of a risk of reigniting inflation than there is the tightness of the monetary policy pushing us into a recession.
Yeah, and just to piggyback off of that, it's crazy how this is true like most of the time, but it's a little different this time. And what I mean is tops are triggered by different events. He said most often they occur when central banks start to tighten and interest rates rise. When the Federal Reserve started to raise rates, 2 years ago? Mm-hmm. We saw the stock market go on a rally. We saw crypto go on a rally. And, they announced that they're going to start lowering rates pretty soon. So we'll see what happens.
Things hit the moon when they started tightening monetary policy, which is crazy.
Yeah, so it really is different this time in pretty much every way. So, yeah, only time will tell.
Time don't give no hints, baby. Okay, maybe I do sometimes. But anyway, let's move on.
That's all it gives. I think it's funny. Next point. In the early stages of a bubble bursting, when stock prices fall and earnings have not yet declined, people mistakenly judge the decline to be a buying opportunity and find stocks cheap in relation to both past earnings, failing to account for the amount of decline in earnings that's likely to result from what's to come. So what I'll say to this is that what he's typically talking about, or what I'm assuming that he's talking about, is a decline as a result of interest rates being hiked up, right? And what happens is a lot of these corporations have taken on a lot of debt. So once interest rates rise, the cost to service their debt rises, like we talked about in the first video. And the stock price will drop because smart money, they're already thinking ahead. They know that, they're looking at their price to earnings ratio. They're looking at, their quarterly earnings calls, and they see like, hey, they're not making that much money. And now their debt just increased. So people start to sell the stock. But, here in America, we're used to that hockey stick growth number go up and to the right all the time. And you have to take into account like the long-term debt cycles and things like that. Just because something dips, is what he's saying, is not always an opportunity to buy. You really have to take into account what's happening with interest rates, with the Federal Reserve, and just what's happening in the world in general.
Yeah, and like today, for example, the day we're shooting this video, NVIDIA earnings were released this morning. And the stock actually declined like 2% after they beat on the bottom line and top line revenue. So that could be kind of the same thing as what he's saying. Like, okay, so the stock price is falling. Earnings haven't fell pretty much at all for NVIDIA, But a lot of people are still looking at NVIDIA as a good buy, especially if there was a pullback today. And I'm sure, a lot of NVIDIA buyers are, getting ready to load up their bag at the moment. So this could be a precursor to something negative. But as I said in the previous point, I just don't see us going backward yet. And so once again, this could be a real buying opportunity. So that would apply more to like maybe pre-pandemic, like I said.
All right, next point.
Ray Dalio, do you know what you're talking about? Like, no. No.
The policies that reduce debt burdens fall under 4 broad categories.
Austerity.
Like, no, he's right. 1, austerity. 2, debt default / restructuring. 3, debt monetization / printing money. 4, wealth transfers from the rich to the poor.
That depends on the country you're in. If you're in a developed country, yes, that's 100% true. And really not even true because we got currency debasement due to the fiat system. And so that's usually the primary method of lowering debt or debt restructuring. We don't really do anything that special anymore. We just debase the currency, make our debts cheaper, and make everyone else's debts, a lot more expensive in terms of our foreign holders. If you're a developing country, it's a bit different. The IMF will probably come in and say, hey, you got to cut spending. You got to increase taxes. You got to decrease subsidies. And you have to do whatever else we say because we're the IMF and we're basically run by the U.S., which is a developed country. And so that point would be different for developed versus developing country, for sure.
Okay, next point. The 2 biggest impediments to managing a debt crisis are a failure to know how to handle it well, and B, politics or statutory limitations on the power of policymakers to take necessary actions. A perfect example is during 2008 when they were trying to go about saving, Lehman and Bear Stearns, if I remember correctly. They could have did it.
Could have did what? Got bailed out?
Yeah, but
talking about this.
But the bureaucracy was so clashing that it took them so long that shit just hit the fan and nothing can do about it. There was nothing they can do about it at a certain point.
Let's just be real. During those times, it was more of a totalitarian regime inside of Lehman. And so they had, I think, 2 opportunities to be saved before they went under. And Warren Buffett was actually one of those opportunities. They waited and they waited and they waited and they waited and they waited till they exhausted all of their options. Then they called good old Warren back like, hey, bro, can you help us out, bro? And Warren was like, hell no.
No, he was like, I got some money. I can probably put it into some the S&P and borrow against it. But, I got to get at least a 3% return on my stock. Call me Warreny. So, no.
Warreny is crazy. No, he basically said no, though. Probably in that voice, like, look, I got about $16
Pretty
billion.
shitty Warren Buffett impersonator.
I got like $16 billion, and I'm not gonna give you any. That was more like George Bush, huh?
Yeah, what the fuck? Sounded country and everything.
But yeah, they had 2 opportunities to be saved, and they decided to not take that opportunity. And that's an impediment inside of an organization that was kind of the catalyst for the rest of the economy going under during that time. But you can extrapolate that out to governments as well and say that, there's kind of like sometimes there's more of a totalitarian regime and most of the times, there's going to be more of a bureaucracy, and which both are impediments usually to handling a debt crisis appropriately.
Next point. During the Great Depression, there were 6 big rallies in the stock market that declined a total of 89%. All of which were triggered by government actions that were intended to reduce the fundamental imbalance. So basically, when the Great Depression happened, what was it, Black Tuesday? What was
Black
that?
Monday?
Black Monday? I forget what they called it, but they basically, I forget exactly what happened, but the Federal Reserve was buying some assets to prop up the market, and the shit still fell through. And this was like the Federal Reserve's first...
During the Great Depression?
Yeah. This was like their first real test. The Federal Reserve came about in 1913. The Great Depression happened in 1929, if I remember correctly. And it was their first time, doing it. And they fucked up hard.
Yeah, they were stockpiling gold.
Yeah. So...
And also, there was attempts at central banks before the first Fed. And we've talked about this before a long time ago. There were attempts at creating a central bank. But some could argue, and it'd be a great argument, that we've only experienced the Great Depression because of the inception of the Federal Reserve, for example, and the extreme currency debasement that we experienced.
Yep. Next point. Typically, governments with gold, commodity, or foreign currency pegged money systems are forced to have tighter monetary policies to protect the value of their currency than governments with fiat monetary systems. But eventually, the debt contractions become so painful that they relent, break the link, and print. Either they abandon these systems or change the amount/pricing of the commodity that they will exchange for a unit of dollars. Sound like
Perfect example.
1971.
Well, even before 1971, I would say 1944, when we initiated the Bretton Woods system. So before that, gold was pegged to, or dollar was pegged to the gold at $20 an ounce. When we started the Bretton Woods system, it got debased down to $35 an ounce. So that way, they could effectively increase the amount of gold reserves that they have on hand to avoid extensive run on the central bank by foreign entities.
Yeah, and the reason why he's saying governments with gold, commodity, or foreign currency pegged money systems are forced to have tighter monetary policies is because you can't print a foreign currency. So it's harder to have an elastic type
A commodity
of system.
currency.
Yeah, and you can't just create more gold out of thin air. So it forces them to be more disciplined. Whereas, if you're the world reserve currency like the US dollar, you can print money because people are going to want US treasuries and people are going to want US dollars as savings. And you can use that money to service your debt as well.
And you could debase a commodity currency or a currency backed by commodities, but it'd just take a lot longer to work its way through the system because you could dilute the actual gold. You could cut it with whatever. And the problem with that is when it comes to a government kind of controlling their money is that it takes longer to get to the system. And so, consumers could still shop for a year before they get a debased piece of gold to spend into, the economy. But it's a reason, guys, why out of 160 currencies in the world, none of them are commodity backed anymore in terms of the legal tenders around the world. Yeah, there are asset backed currencies that exist as complementary currencies, but for the most part, it's all fiat, baby boy. And it's a reason that is because you could do whatever you want. Imagine if you started a nation today. Let's be real. Would you want a gold-backed currency or would you want a fiat? Me, I'm going to take the fiat all day, baby.
I'm taking gold, bro. We about to be shining.
And we about to be the power of the world while his country is impoverished and they can't do anything.
Ouch.
Yeah, sorry.
All right, next point. So we're talking about QE, or quantitative easing, and buying debt assets. So it works by affecting the behavior of investors/savers as opposed to borrowers/spenders because it's driven by purchases of financial assets, typically debt assets, that impact investors/savers the most. When the central bank buys a bond, it gives investors/savers cash, which they typically use to buy another financial asset they think is more attractive. QE certainly benefits investors/savers, those who own financial assets, much more than those who don't, widening the wealth gap. So basically, you got to think about supply and demand, right? If they're doing QE and they're buying assets, it's going to benefit the investors/savers more than the borrowers and spenders more because you're like, if I have a bond, let's call it bond A, and the Federal Reserve prints money and buys bond A or stock A or asset A, it's going to make the value of it go up because they're taking more out of circulation with their unlimited amounts of money. And that's why people always talk about the wealth gap, because people who own most of the wealth, they always have assets. So when the Federal Reserve buys those same assets, the value of their assets go up and they use it as collateral to borrow more money to buy even more assets. And it's just a self-reinforcing cycle.
Yeah.
Next point. This is talking about the 2007 to 2011 debt crisis and adjustment. The pooling and securitization of mortgages, the levering up of investment banks, and the rapid growth of derivatives that were traded off of regulated exchanges. See these as new ways of providing leverage outside of the protection and regulation of authorities.
They are less regulated, 100%.
It's like shadow banking.
Yeah. And mortgage-backed securities, we talked about this before plenty of times. Mortgage-backed securities is like an abstract way to bring value out of the real estate market outside of the building itself, for example. And so it allowed these institutions to kind of play hot potato with a basket of assets in the past. And now, okay, so the two things that the Federal Reserve buys, right? They used to buy gold and they used to just buy gold for the most part. as the hard asset for the reserves that they're keeping on hand. Now those reserves have shifted to mortgage-backed securities and U.S. Treasuries. Because by packaging up those mortgages and creating an institutional product, now that also allows foreign entities to come in and participate in the real estate market like never before as well. And so, yeah, we're effectively offloading our bad debt to other countries a lot of the times.
Yeah, guys, it's essentially creative financing. Like, we always hear about creativity and companies, and finance just seems like this black and white space where it's these old products that's been here for a while. But what they did was actually really creative. They securitized loan payments, and they allowed people to lever up on them, and they pitched them like they were extremely safe. The fucking bond agencies were bribed. Were they bribed?
And they can be safe. I don't know what you mean by bond agencies.
Like they were rating them AAA bonds. Remember?
Oh, the rating agencies.
The rating agencies, yeah. Were they bribed, or what happened with that again?
You know what? I can't tell you. I could say negligence in some case. I could say, someone just fucking people over, like, fuck it, AAA. It could be that. Could be negligence. There were multiple theories around that.
Yeah. So, and by doing it this way, they created something new. And by doing that, it's hard to, like, the SEC can't just put it in a box just yet because it's outside of everything else. So, yeah, you can pretty much securitize anything and add a value to it. So, yeah, just kind of keep that in mind. All right. So now we're going to be talking about the 2001 recession. So it says the 2001 recession, which was caused by the tightening of monetary policy, the bursting of the dot-com bubble, and the shock of all, prompted the Federal Reserve to lower interest rates all the way from 6.5 to 1%. The big rate cuts stimulated borrowing and spending, especially by households. This made the 2001 recession a short-lived and shallow one, but it set the stage for the subsequent bubble period, which was building most rapidly between 2004 and 2006.
Yeah, it's crazy to think about the Federal Reserve cutting rates or raising rates so drastically, considering that even when we raised rates in this last cycle, it was by 25 to 50 basis points. And this time around, it's going to be around 25 to 50 basis points in which we're lowering it. It's hard to imagine, like, by the end of the year being all the way down to like 1%. I don't think we're ever going to get back to below 2% on that Fed funds rate. Wouldn't make any sense, to be honest. And we saw the consequences of having easy money policies for too extended period of a time. And so I doubt we would ever get back down there. But yeah, that's interesting to think about.
Yeah, and also just to kind of like unwind this and unwrap it so it makes sense to you guys. 6.5% down to 1% is drastic, extremely drastic. And it boosted the economy because you have to think about, once the federal funds rate is lowered, it affects interest rates on all products that consumers buy. Cars, appliances, business and personal loans, like all these things. So all these things became cheaper, mortgages. So people are like refinancing on their home, getting new cars, getting new appliances, doing all these irresponsible things. And it boosted the economy because one person's spending is a business's or another person's income. So it made businesses flourish. And I say that with an air quote. And it kind of set the stage for the 2008 financial crisis because, like we said in the first book review, once you are borrowing money, you're spending more than you make. And then once interest rates start to come back down, you have to actually spend less than you make for the same amount of time, all things being equal. So hopefully that makes sense.
And, you get to kind of think about it like when money is introduced to the economy, it usually trickles up or down somewhere, right? And so, or it goes in a loop. For example, on easy money policies, that means banks are more well capitalized, right? If mortgage rates are lower during that time in which they're more capitalized, well, you're going to experience more demand from consumers in terms of refis and purchases, in terms of just the housing market for right now. And now, once they take advantage of these newly found deals thanks to lower rates, that money gets trickled right back up into the institutions. What they usually do with that capital is put it into assets. So they're probably throwing it in the stock market in the form of, ETFs or whatever it may be, some type of derivative of the actual stock when they're dealing with larger sums. And they're usually going to throw it back into that, which shoot asset prices up, which enriches them even more, which then allows them to lend more to consumers. So now they're probably marketing, they're probably doing all this extra stuff to bring in more business, and that cycle continues, and that's how you get bubblicious environments. And you can look at that as analogous to how any industry would work in terms of lowering interest rates, because everything usually starts from the banks when it comes to monetary policy. And so it starts with the banks, and it probably ends with the banks as well.
All right, guys, next point. Growth of new ways, and we kind of talked about this one on the previous one, on how they created these securitization products so they can be outside of the actual exchanges, so they can create new leverage on something else. So it says growth of new ways of lending outside of the normal banking systems, shadow bank, is a common feature of bubble features to build channels that get around more established and better regulated ones because it's initially advantageous to everyone involved. Fewer regulations make it cheaper to lend. Borrowers get lower rates and easier terms. Investors get a small boost on returns. Often, shadow banks are able to make these new debt assets seem safe to investors via guarantees or through how the assets are combined/packaged. Think mortgage-backed securities, how they combine the risky mortgages with the not so risky mortgages, and just because they were all combined made them safe. Without having been through a crisis stress test, it's hard to tell if they're as safe as they're made out to be. Often these innovations lead to the crises.
Well, and so that one, it sounds more conspiratorial than it is. Like, so when you have a basket of mortgage-backed securities, you usually have performing notes and non-performing notes within the same basket, right? And the idea is, okay, if 5 to 10%, just throwing out a random number, if 5 to 10% of that basket defaults, well, you're still going to be in a safe position. You're still going to be profitable. That basket of mortgages is still a good buy. Where they were wrong is it wasn't 5 to 10%. It was a fucking huge percentage. So like 40, 50% of that basket were defaulting, delinquent, or getting ready to default on those mortgages at the time. That's where the mishap came about. And so now it's more so not really the basket themselves aren't safe. It's just more of the reporting around the basket. Is it accurate or not?
All right, guys, last points here. I'm going to combine 2 points, and that'll wrap up like his thought, or at least my notes on his thoughts of 2008. So first off, they were using value at risk. And value at risk is a measure of recent volatility in markets and portfolios. It was commonly used by investment firms and commercial banks to determine the likely magnitude and occurrence of losses. It typically used recent volatility as the main input to how much risk one could comfortably take. But as you know, recent volatility isn't always good if a black swan event happens, because it's just going to be different. The bank's balance sheet and liquidity problems were on both the asset and liability side. On the asset side, problems stem from the bank's ownership of subprime mortgages through securitizations. On the liability side, banks had become dependent on risky sources of funding. The securitization machine started with the issuance of risky mortgages and ended with the sale of very safe bonds to institutional investors. A lender would make the loans and sell them to a bank, which would package them up into a bundle of, say, 1,000 loans. The combined cash flow of those 1,000 loans were taught to be much safer than any individual loan because of diversification. If one borrower couldn't repay their mortgage, that might create a loss on one loan, but that wouldn't affect the ability of the other 99 borrowers to repay their loans. On average, most borrowers had been able to pay their loans, so packaging was supposedly going to reduce the overall risk profile on the loans. So diversification is an interesting thing. You want to have diversification, but you don't want, like, the diversification that they were marketing here was like, oh, if this happens, you're safe here. Like how we talked about the concept of an all-weather portfolio on, the 4 things that affect the economy: inflation, deflation, economic growth, and economic decline. In those 4 quadrants, you can have assets to where if something goes up in one category, it's most likely to go down in another category. This diversification that they had in here, if interest rates rose, which they did, it fucked everything up. So it actually wasn't diversified. It was almost like buying different tech stocks. The factor that would make one tech stock go down is the same factor that's going to make another tech stock go down. And it was literally just a house of cards.
When you're diversifying in a basket of assets that are interest rate sensitive, like mortgage-backed securities. It is a good practice that, okay, some of these mortgages inevitably are going to default. When you shift monetary policy, depending on, let's say if we're shifting monetary policy down, for example, and things become more expensive because we ignite inflation in some way, well, yeah, the less fortunate end of the consumer, they're going to experience tougher times, which means you're going to have more delinquencies. And this includes the lower middle class, right? Because when you're buying mortgage-backed securities, you're not buying homes in the hood. Let's just be real. You're buying homes in that basket. They usually sit in like a lower middle class, like kind of on the brink of poverty, but like not at the poverty line, right? For example. And so, yes, those are going to have a bit tougher time when it comes to keeping up with those mortgage payments. I wouldn't say this type of diversification is bad, but because you're dealing with a solely interest rate sensitive product and you're trying to diversify within that, I wouldn't say that them being diverse in a basket of mortgage-backed securities was a horrible thing. It's just that, like I said in the last point, the reporting around it was kind of jacked up, and how it was packaged was shitty because it was full of subprime mortgages. Now, for example, we don't really have a huge problem of subprime mortgages. So now that diversification strategy would actually work in this environment, for example, and they shouldn't experience a huge level of delinquencies, especially now because the Federal Reserve holds most of these mortgage-backed securities. They've already been operating at a loss for the past couple of years. That will send a huge blow to the Federal Reserve. It's not like they would go bankrupt or whatever, but it would send a huge blow in terms of operating at a loss. And so because we had those subprime mortgages, that kind of rendered that entire diversification strategy shitty, like he said. But the strategy within itself is not shitty. It's just that the contents of the basket were shitty at the time. And so, yeah.
Yeah, the bank should have, I don't know what percentage of their portfolio they had in these mortgage-backed securities, but it should have been way smaller. And when you're exposed on the asset and the liability side, it's crazy none of them caught it. It's honestly
Hundreds
really crazy.
of billions of dollars. And also, it was very levered up. And so you're talking about 30 to 1 in some cases. It's fucked up. So they had, super levered investments with shit. They were levered up on shitty investments. And then they put those shitty investments that had leverage in a basket, which made them even more levered. And they were able to hypothecate those assets. And so, yeah, when things went to shit, that diversification strategy fell through the floor, which we saw.
Yeah, so guys, that wraps it up. We're going to do one more part, and the next one is going to be on inflationary depressions and recessions and currency crises.
Woo! Gets me hot.
And we're going to cover his case study of the German debt crisis and hyperinflation from 1918 to 1924. So be on the lookout for that. Subscribe, turn on the bell notifications so you can get notified every time we drop a new video. Share with a friend who's trying to understand the financial system. Definitely check out our first video that we did on this book. It was really good. But other than that, like, comment, subscribe, share with a friend, share with your auntie like he always say. Aunties love this kind of content. They really do. They listen to it while they're cooking. So
Tell your mama, okay? Tell her come watch me and shit. Like, shit, we could chop it up a bit.
Oh my God. Hey, thanks for watching, y'all. We'll see y'all in the next video.